started with a dream, now you leading a team. Working it closing them deals, working with purpose. You don't walk around with a purse, but you working it, walking the heels. Beauty and brains, speaking and fighting for change. Intellectual and clever, you show the ladies everything a man can do.
All right. Hey, welcome back to another episode of the Flippin and Heels presents Badass Women in Real Estate Virtual Summit. And I have a very, very, very special lady with me today. One of my faves, Ms. Meena Gonzalez. Hey, girl.
Hey, we're live.
We are. Thanks so much for joining us, Ms. Loans by Nina. How's it going?
Everything is great. It's a great time to be in real estate and know about real estate and learn about real estate. So it was very timely, very timely. Thanks for getting this set up for all of us.
Yes, good. So I'm so excited that you are going to share with us all things lending, right? There's so many people who have questions in the realm of lending, financing, all of the above. And I just want to know, I guess you just tell us a little bit about your background. How long have you been in lending? Why lending? And then we'll go ahead and we'll go from there.
Well, my story, I was reflecting on all of that in preparing for this summit. And my story, when I started in the industry, it's a very, Cinderella type of story. I was a commercial banker at a local community bank, and I was servicing our clients that day, and a woman walked in very young, super classy, and she just reeked of wealth. She was literally maybe 24 years old, 25 maybe. So I looked at her, see, when you look for opportunity, you find it, okay? When you're thinking about opportunities, you find them. So I looked at her and I said, I need to service her. So when I was done taking care of her transaction, this was in 1999, 2000, she had $5,000 in cash, paying her mortgage for 2 months because she was leaving the country to South America for vacation. And I was like, who vacations for 2 months? And okay, so she intrigued me. I took care of her transaction. She complimented me right away because she had problems in the past with doing this kind of transaction. So as soon as she was walking away, I said, where do you work? And take me with you. I was 22 years old. So she took out a business card. She said, as a matter of fact, a sales manager is looking for an assistant. The company has an apprenticeship program. And this is his contact information. Well, the next morning I got in contact with him, sent out my resume, did the whole application process. Needless to say, by the time she came back to the United States, I had already been working there for a month. And all the staff thought that we were the closest of friends because because of the connection. I met that lady one time. Needless to say, we did become close friends, and she's still in the industry today. So that is how I got started in the mortgage industry. Never in my mind did I think that I would be a vessel to get millions of dollars out to my community. Never in my mind did I think that through me, hundreds of people would be able to own property, to own investment property, to be able to leverage credits and create and generate wealth with real estate. That was not something that I understood that I had the power to do. But needless to say, going back, I've been a vessel for millions of dollars to go out to our communities for people to be able to acquire and own real estate, rehab real estate, renovate. And that is just so exciting for me.
Love it. So we are going to dive right in. And I love the lessons, right? Like right away, a lesson from that is taking action, taking immediate action, fearless action, right? You didn't know what you were walking into or what you had asked for, but you leaped into it fearlessly, and look at you today.
Yes.
So I love that lesson there. So we are going to talk about transitioning into lending. So what does it mean to even get approved for a loan? You know, I always tell my clients, you know, as a realtor, people come to me and they're looking to purchase a property. I'm gonna tell them the very first thing you need to do is get approved, you know, and I give them, you know, my referrals for loan officers, and then we go from there. So what does that very first step of approval process even look like for people?
So the approval process consists of really reviewing the last 2 years. It's a snapshot, or the pre-approval process. It's more or less a snapshot of the last 2 years of your financial, residential, income generating, employment. You know, that's what we look at in order to see if we are eligible and meet all of the requirements to get a mortgage loan. Okay, so we review. The first thing I want to add about that, let's take a step back, and a word of advice. So if you are watching this summit and you're looking to be a first-time home buyer, or you want to influence others to purchase property, or you're a real estate agent and you want to assess your clients well, make sure that we are prepared with your documentation. Make sure that you have, you know, your identification, that you have IDs. That's something, you know, you need to have upfront and unexpired identification. You need to have a month of pay stubs. You need to have 2 years tax returns and W-2s accessible to you. If you're self-employed, you want to have that 3rd year available. You want to have your pay stub and income documents. Just because you get direct deposit, there is an income statement for you out there. You want to have your W-2s. You want to have access and know where your bank statements are, and have all of your assets ready and available, and the most up-to-date assets. The biggest hurdle that borrowers or applicants encounter is getting all of that paperwork together, or minimally knowing where everything is at, so you can get it out to me. So the pre-approval, what it does is it's looking at your credit, income, earnings, assets, and we are coming up with your purchasing power, what is the number of, that's determined by the percentage of your income that's going towards the house payment and towards all of the other debt that's reporting on your credit.
Mm-hmm.
We don't take into account utilities, cell phone bills, or rent, because you're not going to be paying rent once we get you this loan. You're going to be paying your house note or mortgage, and those are the initial steps. The biggest encounter or the biggest challenge that some individuals have is actually locating their documents and getting it all together and in order.
Okay. Now, let me ask you, why does it seem like it is more difficult for individuals who are self-employed to go through this pre-approval process?
Because the biggest obstacle that most self-employed individuals have when acquiring financing is the documenting of the income. How are you documenting your income? You don't receive a pay stub, and if you're like 1099 or commission only, you may receive a pay stub, but it doesn't have any deductions on there. Mm-hmm. So what's utilized is the last 2 years of tax returns, or the actual the last 2 years of earnings.
Okay.
On your adjusted gross income. So you can take advantage of a lot of tax write-offs. And once you take advantage of those write-offs, everything that you have, your income afterwards, that's what is used to qualify you to purchase a home. An example, your gross income was $100,000, and you claimed $60,000 worth of expenses and losses. So now your income to purchase a property is $40,000. That's our base. That's where we're starting. And that is the biggest challenge is that our entrepreneurs and self-employed individuals do take advantage of their tax write-offs and expenses, because technically you only want to pay taxes on what ended up being your net, and your net income, what is your, that's what we base the mortgage loan on. There's different programs out there that utilize, so if you're self-employed for over 5 years, you can use your last 1 year of tax filings.
Gotcha.
Can we pause?
Yeah.
Okay.
Yeah.
Okay. The dogs are going to be coming in, and I didn't know the noise level that was going to make.
No, it's all good. Yeah, we can edit it out.
Oh, okay.
Yeah. Let me know when you're ready. That was good though. You was rolling, girl.
Yeah. What happened? That's fine. Yeah, that's right. So I fumbled through the last self-employed part, but okay. I'm ready.
Okay. All right. Okay. Do you want to go back or just ask a new question?
Why if I have my do not disturb on, why are people still able to call me?
Girl, I don't know how this stuff works.
Okay.
So, all right. So,
going back, did you want to go back to self-employed? How I want to tell them how to fix that, how to remedy that.
Yeah, you can just start back up and say,
okay.
So you can say, so how you remedy that. Yeah.
So how we remedy that for self-employed individuals, just be very mindful. If you're looking to purchase a property within the next year and a half, you want to be mindful of how you file your last tax year filing. Ensure that it is more reflective of your true income, and make sure that that's how you file next year as well. You use a 2-year average for your self-employed income, but for individuals who have been in the business for 5 years or more and the approval system allows them to, they can only present one last year of taxes, right? So if you have good credit, some decent savings, and you get approved through the automated system, you've been self-employed for 5 years or more, it may only ask for the last 1 year of tax filing. So if you're going to file 2019 now, there's still an opportunity for you to get approved to purchase a mortgage if you just stick to not counting as that many expenses.
Right. Good. And you mentioned the word purchasing power. I'm so glad that you mentioned that, because oftentimes, there's like a pre-approval amount, but some people say that, oh, you can spend up to this amount, or you should, or you shouldn't spend up to that amount. So can you explain why people say that and what that dynamic is about and what it truly means when you break down the picture? So for example, let's say someone does obtain a pre-approval and they get pre-approved for, $250,000. Is that a real number that they can expect to say, oh, this is what I can afford? Or what are some other things that they should, consider and take into account with all of that?
The biggest thing to consider when getting your pre-approval amount is how much taxes and insurance are going to be for each property that you're looking at. That is the biggest variable that we use estimates on. So sometimes when my clients and we're out there getting them ready, right? I may ask, what region are you looking to purchase in? Where are you looking to purchase? Because it lets me get a gauge of a median amount where taxes may be for the region that they're looking to purchase. Mm-hmm. Outside of the interest rates on your lending, I usually use a little bit of a higher interest rate when calculating a pre-approval. The biggest variable is taxes and insurance. That's something that we won't know until you locate the property, because it's very property specific.
Right.
Purchasing power is the percentage of your income that can go towards a mortgage payment translated to a loan amount.
Mm-hmm. Gotcha. Okay. That's good. Thanks for breaking that down. And you're absolutely right. And that's why also it makes so much sense to narrow down the areas, which you're looking. So sometimes I do get people who are like, well, area doesn't matter. It does. Where do you want to look? Where do you want to, and most people are just trying to get the best bang for their buck, but it matters. And I'm glad that you broke that down, because even just in Chicago, like there's different areas to where, okay, a 3-bedroom, 2-bath taxes might be $5,000 over here, or a 3-bedroom, 2-bath taxes might be $1,500 over here. I mean, that's a huge difference and something to definitely look out for. The next thing that I want to ask you, that I want to talk about, student loans. So there are a ton of people who are looking to, purchase and get financed through, like, what's the truth about, student loans and getting financing with student loans? And, there's probably so many myths out there. There's actually people who think they can't buy a house because they have student loans. So what does that look like if I do have student loan debt and I am interested in purchasing, whether it's investment property or, my own house to live in?
That's an excellent question. That's an excellent question, and it's a fully loaded answer, right? So student loans are, they get calculated even if you're in deferment, even if you're in forbearance. We still need to take into account a monthly payment for your student loan balance.
Wait, so even if I don't currently have a payment on my student loans, when I go to get approved for a property, you have to calculate a payment? I
have to calculate a payment.
Why is that?
Most of these student loans will come into repayment during the term of your mortgage. So we need to have a risk factor to ensure that you can manage that student loan payment and your mortgage when it starts coming into repayment. Mortgages are 30-year terms, and we're forecasting that within those 30 years, you will have to make a repayment on that student loan.
Gotcha.
We will use 1% of the loan balance, traditionally, 1% of the loan balance as a proposed payment. Okay. Mm-hmm. There are programs that allow you to use what's reported on the credit, even if the monthly payment says 0. But those are different types of financing, and they really want a more well-rounded applicant. That means stronger credit scores, more assets and reserves, and stability in your last employment.
So if I have a $40,000 student loan debt, you would automatically, let's say if my loans are in forbearance, you would automatically calculate a $400 payment that I'm paying towards student loans every single month.
Yes, we will have to put in a risk factor. That's if they're in deferment. If you're in repayment and you have the terms of your student loan, and your terms are less than that $400 a month, then I could utilize the actual terms to get you approved for a home. So $40,000 loan term, I'm just using an example. Something is coming back to me, obviously maybe a file that I looked at. So maybe $253, right? Mm-hmm. So now we've reduced our monthly debt and liabilities, which can assist in increasing your purchase power. Mm-hmm. Okay.
So in any case, do student loans mess up people from being able to buy?
It can. They can. Mm-hmm. One of the biggest things that you want to make sure is that they're in good standing, right? So they're federally subsidized debt. So you want to make sure that it is in good standing, because if they're not paid on time, that can stop you from purchasing a property. Okay, that can stop you. There is a back-end federal list that even if you're good on everything else, but your default on the federal, this federally subsidized student loan, then you cannot even use this program to purchase a property. Okay, so you want to make sure that your student loans are in good standing, that you're in repayment. If the liability is very high, so if you have a very high student loan amount, it can impact your purchasing power. Solutions to that are documenting the true terms of your your loan, or getting yourself, getting that credit in line, getting some savings in line. So if that $40,000 student loan debt if you're in some sort of special repayment, that $40,000 is actually $83. If we're able to qualify you for these less risk adverse mortgages, then I could use the $43 a month.
Right. Wow. Whew. Good stuff. Okay. That's good. So I'm so glad that you broke that down, because so many people are confused about student loans. I too sometimes get confused because thankfully I don't have any student loans. So whenever someone has a question about getting finance and student loan, I just refer them to you. But I didn't know the fully, what is looked at, what's calculated, and how it's calculated. But I did want you to break down some myths around it as to, people thinking that they have student loan debt, that, they may have $60,000 and like, oh, I'm $60,000 in debt. I'm not going to get approved for a loan, when essentially, there are programs to help people out as long as they are in good standing.
Yes.
Good. Okay.
I've been able to finance individuals who have $200,000 in student loan debt, right? We were able to properly document the terms, and her purchase power was lower than what she had anticipated, but enough to find the house of her dreams. She ended up locating something that was realistically what she can get approved for, and she didn't realize when she translated that number and went out there actually actively searching, because that's important. What you see on the internet, it's not always what's available for purchase, right? A licensed real estate agent can actually get you live, up-to-date listings that's available exclusively to agents on your database.
Right. Absolutely. Love it. Cool. So, I want to actually transition into loan type. So we talked a lot about, just I think you could say just some of the particulars, regarding getting approved, what that means, what you look at, what you look for. But let's break down like the different loan types, like FHA and conventional, and why one would or should go with one over the other.
I want to bring up the first one. I got
you working today, girl. I know.
Yeah, no. I want to bring up the first one you didn't mention. I was hoping you would mention it, but it's VA loans.
VA.
So I really wanted to talk about veteran loans and sort of demystify that a little bit. So the VA loan is available with 0 down payment and no mortgage insurance for veterans who are eligible to receive this benefit. It's also eligible for spouses, right? So if you're a widowed spouse from a VA individual and you have the appropriate benefits, you can also utilize this program to purchase a property. Right. But it all has to be in good standing and appropriate and have the proper documentation for it, because I can't find it for you. Okay. So it's 100% loan where you don't put a down payment. Interest rates are very competitive. They can go down to a 580 credit score. And the loan limits have recently been increased for veterans as well. Okay. There is the restrictions on foreclosures and bankruptcies are totally different for veterans than they are normally. Okay. So the requirements for any of those big derogatories are lessened. Okay. And it's dependent on a lot of criteria of the veteran themselves. And what the VA loan is, it's a percentage of the loan is backed by the federal government, and you have this entitlement where they would issue and protect the lender in case of any default. So You can technically get 100% financing, no mortgage insurance. The biggest caveat with veteran loans and multi-unit lending, all right? So multi-units and veterans, it's an excellent program, but unless you have landlord experience or property management experience, you cannot use the rental income from your proposed property to qualify for more. Whereas the other kinds of mortgage products, bless you, the other kinds of mortgage products, you can utilize that rental income as effective income. All right. So for example, $150,000 2-unit, the veteran has to be able to qualify with their own income, not the potential rental from the second property. From the second unit.
Mm-hmm.
When we move over to FHA, you're allowed for a 3.5% down payment up to a 4-unit property, and you can use the proposed rental from those other units to qualify for this mortgage and purchase. So your income plus the proposed rental of these additional units can help you qualify for this property, therefore increasing your purchasing power.
Good stuff. Now, what if, on the backside of that, like, what are some things to be careful for? What are some cons, like, with you being able to qualify, like you said, as far as projected income? I guess what worst case scenario is vacancies, pretty much, like tenant vacancies or not being able to meet that projected income.
So 75% of the, there's a 25% vacancy already taken into account when we use this projected income.
Okay.
So even if the unit is vacant currently at purchase, during the appraisal report, we'll get a market analysis and utilize the market rate given by the appraiser to put a number to the rental on that unit. Okay. So even if it's not rented, we would have a number on our appraisal report.
Good. Cool.
Now, I think I brought up a very good word, and that's appraisal. So an appraisal is where we send out an assessor to the subject property to look at all of the area sales and compare your property to other sales in the area within a 1-mile radius, and they concentrate in the last 6 months of sales. Okay, so that would predetermine the value of your property. Since we are using it as collateral, we want to ensure that what we're giving you the money on, what we're loaning the paper on, is worth what the seller is selling the property for.
Right. Because if not, then the bank doesn't want to lend money on an asset that's overvalued.
This is true.
Yeah. So I think that's so important too, because oftentimes I share that with my clients. Obviously, as a licensed realtor, I do have a lot of clients who are looking to purchase property, even through like FHA, and I let them know the different phases of a contract and the different clauses that are set in place to, like, if this happens, if that happens, like, you can't get out of the contract. And so sometimes the question does come up, well, what if the property isn't worth what, we're putting in an offer for, especially in a market like today, where we're in a market of multiple offers, we're highest and best, and we're trying to calculate, putting our best foot forward and submitting the best offer. And then my clients are asking, well, what happens if, the property doesn't come back as appraised? And so I let them know, hey, well, there is something that is called an FHA mandatory clause that you actually are going to sign, you and the seller is going to sign. And it states that if the property does not appraise over, your purchase amount, well, at that point, you can go back and you can renegotiate the property. You can try and work something out, or it allows you to walk away, and your earnest money deposit or anything that you put down is in jeopardy. So I'm so glad you brought that up, because properties do under appraise.
Yes. They do.
Properties do under appraise. And
Yes, they
so
do.
what is that like? I mean, I'm sure it's a range of emotions for your clients, for one.
Yeah. So it is, that's a conversation you want to have like early on. You're one thing that I always recommend. Okay, this is my upfront way recommendation. I tell the listing agents, be at the appraisal appointment. Try to be at the appraisal appointment, because there's a big percentage of agents that will just give the lockbox code or make arrangements for the appraiser to access. But sometimes you want to be there, you want to have your comps ready. These are the comparables that I used. In a market where there's a lot of sales going on and the properties are in the price point that you're selling, you might not have to do that. But if you're looking to break the market, or maybe you have less comparables, or you're on the borderline of, a neighborhood, it may be a good idea or a best practice to be present at the appraisal appointment if you are the listing agent. So that's my little 2 cents on that. But going back, you have to renegotiate. You have to have this conversation early on. If the appraisal comes back below the purchase price, you give the opportunity to communicate with all parties that this appraisal, came in low. You provide a copy of the appraisal to the buyer and the buyer's attorney. At their discretion, you can start to review the comparables and see if there's any kind of rebuttal opportunity. Sometimes there are not. Okay, sometimes there are not. So there is a small window to try to let the appraiser know, hey, this is why, and you prepare a report and you give new comparables. But at times it just comes back at the same value, right? Because they're vetted and professionals who go out there and are in the trenches daily, So the opinion that they have, they usually stick to it. Okay, usually they stick to it. There's times when either there are types of renovation or zoning changes or things of that nature that is easier to, change the appraised value on a property. So we get the appraisal. It came in, let's say, $10,000 short. Now we go back to renegotiate if the seller is willing to change, or what are we going to do about this appraised value? Because I cannot overlend. Now my base amount for my loan is on this appraised value, right? So technically, you're liable for coming up with the additional $10,000 that they was short plus your down payment, right?
Wow.
So this changed to $7,500 down payment to now $17,500 down payment. Okay. So it's always ideal to ensure that, one, you get that negotiation started very quickly in regards to making change to the purchase price. At times, both parties come to an agreement, right? They say, well, I can't pay the additional 10, but hey, reduce it by this much and maybe reduce your seller credit. Like, the parties get into the negotiation piece of the contract. So that opens up that negotiation again.
Yeah, and I think it depends too, like for the buyers, how bad you want the property. That's why I tell people, how bad do you want it? But at the same time, let's be smart about it too. Do we feel as though the property is actually undervalued? Do all parties feel and agree that? Because of course, nobody wants to be completely upside down on a property. However, I've been on both scenarios. So I've seen it to where, there was a property that under appraised, and all parties, the listing side, the sell side, all parties believed that the value was there. So they were able to actually come to an agreement. And I've seen it to where it was like, absolutely not, this price is ridiculous, and walking away. So I'm glad that we did bring that up though, because that is something that a lot of people have questions about, and they may fear that. So that may be a reason that they never even move forward with an offer or buying property because it's like, well, how do I even know that it's worth that? Well, the bank is going to send out a licensed individual, to document and do their research and run their numbers. And then, and then this happens, and it can be good. It can also go good, right? The property can come back, it appraises out,
a little higher,
and everything's good. And next step is the closing table.
Yeah.
Oh.
So I know we went into appraisal, but I thought that was just an important piece to talk about. So if the property has rental income, it will have market rent. You will have a few comparables on there, and you are entitled to a copy of this appraisal as soon as it's available. Okay, it should be given to you within 3 days of it, the appraised value being given on the property.
Gotcha.
So,
and then what about, so you talked about VA loans, FHA loans, and what about conventional?
So conventional, when I was talking about set down payment amounts for VA and FHA, it's usually across the board, 0% for VA, 3.5% for FHA. For conventional, it can vary, property type, credit score, right? That can vary your required down payment. The staple is 5% down on a single family property, right? That's about what the staple is for conventional. The more amount of units, the higher down payment requirement. So a 2-unit will have a 15% down payment requirement, and then 3 to 4s, it can range anywhere between 20 to 25% down payment.
Okay.
So that shift, it's like it's a credit score, it's a property type. That's how it works with conventional. Or VA and FHA, it's pretty much across the board the same down payment.
Gotcha. And that down payment varies even for owner-occupied too?
Yeah.
Conventional. Wow. Yep. Yeah, big differences.
Yeah.
Big differences. Okay.
So one thing to talk about in regard to the FHA, as we're going into the conventional conversation, is the mortgage insurance and upfront mortgage insurance premiums. So why does the FHA allow you across the board to be at 3.5% down payment? Because they have some sort of risk built into your financing. So if you don't put 20% down payment, there is mortgage insurance required, which protects the lender in case you were not to pay the financing. Or percentage of the mortgage balance is insured, right? And you can make an insurance claim. So the lender reports a loss, but it's not as big as a loss as, they can claim back some of the amount that was defaulted on. Okay. With FHA, that stays on for the life of the loan. Okay. That was an act that was put in place less than 10 years ago, and it was set to expire, but it didn't. And now it just stays on for the life of the loan. Mortgage insurance stays on until either you refinance out of an FHA loan or you pay off the mortgage, unless you have a 15-year term. Okay, so if you have lower terms, that allows to eliminate the mortgage insurance.
Wow, man, so many gems. Okay, so how do lower terms, like you said, a 15-year versus a 30-year, how does that eliminate mortgage insurance?
FHA has requirements, and there's, a table out there that the lower terms on your mortgage, you can eliminate it after a certain amount of years. Okay. So if you get to that equity level, 78% of equity level on a 15-year mortgage, you can visit eliminating the mortgage insurance. But
at least for now, as it stands.
As it stands.
Gotcha. Okay.
With conventional, and the beauty of conventional is that mortgage insurance does not stay on for the life of your mortgage, right? So you can eliminate mortgage insurance by having a 20% equity level points or more, or you pay down the balance to get to that. So either the home appraises for more, or you've paid down the balance to get to that 20% equity, and you can eliminate mortgage insurance.
Gotcha. And then what are some reasons, I guess, one person would pick one option over the other? Is it mainly because of that, when you see people who are debating on, do I want to go FHA or conventional? Is it because of that mortgage insurance, or is it because of probably that and maybe like the down payment?
It's a combination of those. And then also it's a combination of the mortgage insurance, the down payment, and also property condition. FHA has higher requirements and higher standards on how this property should be, right? So you may encounter some sales that say no FHA, cash or conventional only, because they feel that the property, the FHA inspection is too rigorous and won't pass. So there's some people who say, well, I want to switch my approval to conventional because the property I want will only accept conventional financing. Most of that is found early on in the on the listing, right? It's very rare that you'll find those restrictions when you're already in the offering process.
Right.
But I just wanted to touch on that a little bit. Most lenders, all right, including myself, if you can get a conventional option, I'm presenting it to you at pre-approval, right? I'm most likely already presenting those options if you have all of the right pieces at initial pre-approval, giving you options B and C so you can compare them. Most
good lenders.
Yeah, most. I have clients who I don't do that for. It's usually because they don't have the assets, right? So it's usually they don't have the assets lined up. So I probably won't write the pre-approval for a conventional. But let's say they go out there, they say, Nina, I need this property. I'm looking at it. It has to, I would like to look at this property. They say it's a conventional. And I'm like, okay, can we, now that I'm going to go in and see if we can revisit this. But most likely I've probably already screened it for conventional. We want to make sure that you've actually, because you don't want to be blindsided by something. You want to have, when your buyers come back to you, you can say, well, I didn't present that option because the credit score is not there, or we're looking at this kind of setup, or, whatever, or we don't have the required down payment for that property type. Do you have any more funds you didn't disclose initially? Is there a gift? Do you have like a 401k or something that you can get this down payment from, or things of that nature? We revisit it at that time.
Right. Good to know. Man, oh my goodness. There's so many gems. Whew, girl. So I don't know about you guys, but I hope you are definitely taking your notes, because I definitely am. I do have a couple more questions before we wrap up, if we can go through them quickly. I really just want to touch on like down payment down payment assistance programs, and refinancing. So I don't know if those probably are not quick topics, but
we can touch on them fairly quickly.
Okay,
so
let's start with down payment assistance.
3 things to watch out with down payment assistance, or to be mindful of for down payment assistance. Most of the down payment assistance dollars out there have household income limitations, right? So if you are at a certain threshold of income or higher, you're not eligible to receive these down payment assistance dollars. We want to ensure that, because they change per municipality and across the United States, there are all kinds of down payment assistance. Most of them do have a maximum household income. All right, to be mindful of. There is a credit score requirement. Okay, so most of them will have 640 and above. I've seen some in different states that are 620 and above. I've seen some programs that are a 660 and above, right? So
Right.
it's ensuring that you meet the credit score requirement, household income, property type, okay? Down payment assistance focuses on single family units or 2-unit properties, multi-unit properties. Some areas and regions, they call them duplexes. Here in our region, we call it, a 2-flat. So that is when there are 2 residing units, 2 residing legal units, maximum is what's usually where these down payment assistance dollars are reserved for. So those are the biggest thing. They range, down payment assistance can be $1,500. It can be up to $10,000. It will definitely depend on the region that you're in and the participant and the provider of this down payment assistance.
Yeah, thank you so much for breaking that down. And also look at any local housing programs too, right? Like
They are
those are
excellent, yes.
neighborhood specific too, and there might be some programs. And what I've noticed is that those programs come and go, but you might be in a period where they have it available.
It's there,
Yeah. So you got to get it while you can. Cool. And the last thing before we wrap, man, oh my goodness, this has been an information pack. Like if your notebook is not full, I'm gonna need for you to rewind this interview and watch it again. But refinancing. So there's so many questions around refinancing. Should I or should I not?
So it's going to be very subjective. The refinancing is really based solely on your balance, your goals, and your current interest rate, right? So if your goal is to shorten the term of your mortgage, this might be a very good time to reduce the term at a very low interest rate. Okay. So let's say
if it's lower than like the rate you already have.
If it's lower than the rate that you already have, or there's some occasions where it may be just about, but there's reasons why somebody needs to refinance. So if it's almost the same interest rate and you're looking to take out some cash out the property, it might be a very good time. So what are you going to do with that cash? Are you going to debt consolidate and save yourself $300 a month? Then it's a good call. Yeah, let's look at refinancing. If you want to reduce the term of your mortgage and, you're reducing a 15-year, let's say you have about 25 years left and you want to bring that down to a 15. That's something actually to be very mindful of if you're able to lock in and secure a lower interest rate. There's some situations that people want the cash from the equity to purchase new property, and maybe they have a lower interest rate, but they might go into a higher rate. But if that money is going to work for you, right? If those soldiers are making more dollars for you, it might be a very good time to refinance.
So the best way to pretty much figure out if it's the best time to refinance would be to speak with a loan officer about just all the different options and, like you said, the scenarios. And I do know that there's obviously no blanket answer, and everyone is different. But some things, I'm so glad that you pointed out those different scenarios. You're like, it depends on this, and this. And so
it does. It's very, there's FHA streamlined options available that, we're just, as long as you pay the mortgage on time and your credit score is above a certain range, we're not even verifying anything else. Okay.
Wait, say that again.
FHA streamlines they look at your mortgage payment history and your credit score being above a certain range, and you're not verifying anything else. You can even do a streamlined refinance without an appraisal.
But is that still going to be an FHA property?
It would still be an FHA. It would be
Gotcha.
FHA to FHA. That's the streamlined part of it.
Gotcha. Okay.
I know we're wrapping up, but there's one thing that I wanted to just inform the consumer, and I sent Roshana this article. But you are protected for 45 days while in your pre-approval process. You can have multiple, credit inquiries from this kind of lending and it not impact your credits, right? So if your credit is, let's say, fragile, For any other reason, if you're looking at mortgages or getting pre-approved, those additional inquiries shouldn't be what's impacting your credit. If you've seen a negative change, it's possibly that there's other areas in your credit that need to be looked at. But that empowers us to be able to not only get the best financing, but also prepare ourselves in order to increase the credit scores. If you need to have a look or refresh on getting those credit scores up, then you can have a second look within those 45 days and it not impact your credit.
Right. Good. Yeah. And it's an opportunity for you to shop for the best lender, who is the most knowledgeable, who is speaking your language, who, you know, who's talking to you in a way that you can understand, especially if you're a first-time home buyer. Like, oftentimes I have clients who might have a conversation with their lender or their attorney, and then they turn around and call me and they say, okay, so he just said this, what does this mean? You know? And it's like, and of course I will try my best to explain it, but you know,
we have to talk in the language,
right? I'm like, it's their job, but I'm gonna try and do what I can to explain it. But that's so important, is that you speak with a professional, because when you're hiring, we always talk about like the different professionals on your team, right? So your lender, your loan officer, your attorney, your realtor, especially if you are a newbie to this. People need to speak your language. They need to speak and if they can't, I don't know. I don't care like how many degrees you have. If I don't understand the process, like, I'm gonna be confused, and you cannot make comfortable and confident decisions when you feel uneducated and confused.
Yeah, I 100% agree. And, you know, we have to be very mindful of that. Just because we're experts in our field, that means that we don't regurgitate it that way. We really need to communicate in an effective way that you understand. You know, it's the mirroring effect. You really need to understand and speak the language of your clients.
Absolutely.
Biggest takeaway that I have for anyone out there that is looking to get financing, or if you're in the business and you want to help your clients be ready, is preparedness. Make sure you have your pay stub. I bring this up a lot because it happens to me on a weekly basis. Individuals who don't know how to get their pay stubs because they get direct deposit. Online banking, they don't know how to share their statement. So I don't mind, but it would be very effective for you to ensure that you have all of your documents lined up. Concentrate on 1 month pay stubs, 2 years tax returns and W-2s, 2 months bank statements, and an unexpired ID, and you are on the winning team.
Boom. Well, I love the fact that you talked about like just being able to communicate effectively, because I think you broke it all down today. So, girl, thank you so much. Where can the people find you, follow you, you know, keep up with you? Clearly you drop gems. They're gonna have questions. They're gonna be running to you to get approved. So where can we, you know, just connect with you and learn more about this industry? Because these are conversations that we need to be having. You know, whether we are wanting to get prepared or share the information with somebody else. How can we find you?
Loans by Meena on every platform, LinkedIn, Facebook, and Instagram as well. All of my contact information is on the your link to bio will take you to my website, and you can actually apply for a loan today directly to my website. I have an email address, homeloansbynina@gmail.com. That's what I use for social media. And my office email is meena.gonzalez@grarate.com.
Cool. All right. Well, thank you so much again for dropping all of these gems. And
thank you for having me, Rashana. I am so excited for everyone who's viewing this summit. I am excited for each and every one of you guys. I can't wait for all the testimonies and all the great stories.
Thanks so much. All right. Talk to you soon.
Bye.